Welcome to the Financial Pig. In this video, I'm going to be talking about corporate bonds. In my previous videos, I've already shared with you the investment pyramid, which shows the different types of risk profiles from conservative, moderate, and aggressive. Now, conservative type of investments, these are the savings deposits, time deposits issued by the banks, and of course, the government securities like the treasury bills, RTBs, and FXTNs. I've also made a video about a moderate type of investment issued by the bank, which is the long-term negotiable certificate of deposits. I've actually skipped making commercial papers because this is very seldomly issued by the corporations, and I've only really sold a couple of them in my experience as a banker. We're going to skip right ahead to the corporate bonds. Now, corporate bonds are moderate investments because you have to lock in your money within a period of time, which is longer than the savings deposits, which are easily withdrawable, and longer than time deposits, which are only like 1 year and less. Our presentation guide will talk about what are corporate bonds, who offers corporate bonds, how much you can earn, when you will get your money back, what if you sell before maturity, what will happen then, and of course, how do you open an account? So corporate bonds are issued by corporations. It's actually in the name, corporate bonds. Their tenor is 2 years and more. As I've said earlier, the more issued tenors are 5 years and 10 years. Now, this also has a fixed interest rate and it has a maturity date. So if your corporate bond is 2 years, after 2 years, you're gonna get your money back while receiving a fixed amount of money within those 2 years. Now, it can also be puttable or callable. Now, the difference between a puttable bond and a callable bond is the person who is allowed to redeem the investment. So let's say you have a 5-year bond. If it's a puttable bond, for example, it's puttable on the 3rd year, you as a client are allowed to redeem the investment on the 3rd year. But if you don't really need the funds and you want to continue with receiving your interest until the 5th year, then you can always do so. On the other hand, a callable bond is the issuer or the corporation has the right to pay you back as the client the money on the 3rd year, if it's a 5-year bond, for example. Okay? Or the issuer can decide whether or not to redeem on the 3rd year or to continue with the 5 years. So, of course, the ones that offer corporate bonds are the underwriter banks and investment houses. Usually the corporations will talk to the banks or the investment houses and say, hey, I want to offer bonds to raise capital for expenditures or operations. As a client, you can actually earn higher than savings or time deposits because your money is locked in a longer time, and so there is a little bit of a more premium paid to you as the lender of the money. And the rates are actually dependent on how much the interest rates are in the market. It also depends on the corporation that you are investing in. So let's say Corporation A, which is Ayala, is offering a 3% 5-year bond. And this other corporation, which is a little bit more risky, is also offering 5 years. If it's more risky, then they have to add a little bit more premium compared to the safer companies, because then the clients will prefer to invest in Ayala, for example, if there is no risk premium put on the bond. To calculate interest income, it's fairly straightforward. It's principal multiplied by the interest rate multiplied by time. Now, the time can actually be quarterly or 4 times a year you get your interest payout, semi-annually, or 2 times in a year you get your payout. So an example would be if you're investing in Ayala bond 3 years and you have a 500,000 pesos, the coupon rate is 3% gross, and you are charged 20% withholding tax. This is how you will compute for it. So 500,000 is your principal multiplied by 3% the interest rate. Of course, you have to deduct the tax. So you have to multiply 1 minus the tax 20%. That comes out as 0.80. And multiply it by 1 over 4, which is the time, because you are being given out quarterly interest. So the answer to this will be 12,000 pesos annually, or 3,000 pesos every quarter. Now, if this was a semi-annual bond, semi-annual interest-paying bond, then you would get 6,000 pesos every 6 months. But still 12,000 annually. Okay? Since this is in the Philippines setting, withholding tax for individuals is 20%. Corporations also get taxed 20% unless you have went to the BIR, or the Bureau of Internal Revenue, and applied for a tax to become a tax-free corporation. Usually these are the religious organizations or the foundations. When you will get your money back is on maturity date, or putable date, or callable date. But you can also sell your investments back in the secondary market before the maturity date, but it depends on the market price. And of course, they have to take out the broker's fees. So my advice is, if you plan to place in bonds, make sure that you can do without the money before you lock in your money in the bonds. It's best to allocate savings ahead in case of emergencies. Now, this is one thing. If you're a new investor and you want to sell before maturity date, you have to ask your trader or your manager how much proceeds you will receive before you actually sell it, because there's a chance that your principal will be depleted if the prices in the market have gone down. So let's say your Ayala bond, originally when you bought it, was 3%, and you were planning to sell it now. But what if other investments in the market, 3-year bond is 2%? That would mean that your bond has a higher interest rate than the others. So this could be, ideally, your bond will be more expensive or have a higher price than the others. So if you sell it, then you will get a premium over over your principal amount. On the other hand, if your bond is 3% interest rate, while the other bonds have already gone up, then your bond will have a cheaper price. And this is based on my experience as person who sells investments. Sorry, I just blanked out. Okay, so interest rates and the prices actually have an opposite relationship. So if the interest rates go up in the market, the price of your investments go down. If the interest rates went down in the market, then your existing investment, the price will go up. Okay, so how do you open an account? You go to a bank near you. Usually the ones that offer the bonds are the bigger banks. So you go to your top 5 banks. Actually, top 10 banks offer these, so you'd have to ask them. Inquire for corporate bonds. Usually they offer them through the Treasury Department or your trust department. And you can get them as a new investment, primary offering, or the secondary market, or you're trading in the secondary market already. Someone already bought it before you and have sold it in the market, and you just bought it from them. So the advantage of buying it at a primary offering is that you don't have to pay for the broker's fees. It's clean. If you buy 500,000 worth of bonds, you just pay 500,000. On the other hand, if you buy it at the secondary market and the price is a bit higher than the original one, then you'd have to pay a premium price plus the broker's fees. But if you got in at a price that is lower than the original price, then you'll be in luck, because then you will get more yield over the original one. So you can open an account by bringing your documents like your 2 government valid IDs, your TIN number. This is very important because ever since they became more strict at the BIR, you always need to show your TIN number or tax identification number for them to do a proper tagging of the tax. And of course, they will make you sign other documents needed by the bank and your personal details. So once you do this, you actually go to the bank and then they will tell you you want to reserve in this bond. It could be, let's say, SM Prime bond. It could be, oh, you want to reserve it in this. How much do you want to reserve? So let's say you want to reserve 1 million. They're going to reserve you the bond, but they will tell you if you're allocated or not at a later time. So you don't expect all the time, but you have to make sure that your money is available anytime for you to pay for the bond. Okay, once you get the allocation, then the bank will give you the documents for you to sign. If it's a secondary offering, then you'd have to fill out the documents first before you can buy in the market. And of course, once you buy the bonds, then you will get the confirmation of purchase and the securities receipt confirmation, or SRC, given by the PDTC. There are so many acronyms here. PDTC, or the Philippine Depository Trust Corporation. Now, you should always keep these documents because you will have to show these in case you want to sell back your investments before maturity date. But otherwise, in my experience, if you buy a bond and you wait for it until maturity date before you get the funds, then they will credit it to your bank account linked to that investment. Okay? So please comment any questions or message me so I can help. I've done so many takes. My eyes are tired from the ring light. Have a great day.